May 6, 2010. The U.S. stock market drops 5% in just 4 minutes. Trillions vanish. For a moment, nobody knows if the entire system is about to collapse.
400 very quickly, and then down 800, nearly 1,000 in a heartbeat.
I mean, it is classic capitulation.
Commodities that are being crushed.
There may have been a bad print in Procter & Gamble.
Investigators scramble for answers. Wall Street blames a glitch. High-frequency firms point fingers at each other. But when the data was dissected, the truth was stranger than anyone imagined. The crash wasn't triggered by a bank or a hedge fund. It was traced back to one man, sitting alone in his modest bedroom in Hounslow, London. A trader armed with nothing more than a mouse, a ladder, and a custom code he built to fight the machines. And from that day forward, the hunt for him began. Punjab, India. A young couple decides to leave while they still can. Work is irregular. Money stretches and then runs out. They want a place where effort has a clear result, so they pack what fits and go. West London, early 80s. They buy a small house in Hounslow because it's the only one they can afford. It sits under the flight path. Planes pass low, shifts stack up. The mortgage gets paid. The rule at home is simple. Keep moving, keep improving. Their son is Navinder, Nav. He grows up in a house that runs on schedules. School on time, chores done, receipts saved. He is quiet, direct, good with numbers. He repeats tasks until they make sense. If something breaks his focus, he removes it. That habit becomes the center of how he works. At school, he learns to sit with the hard problems until they move. Games were practice for him. Same opponents, same choices, small adjustments that win the next round. He learns that progress comes from tracking what repeats and acting on it. By 2001, he is accepted into Brunel University, where he chooses computer science and mathematics. He moves into shared student housing to cut costs. Among his roommates, one detail catches his attention. A friend always has cash to spare. Curious, Navinder asks how. The friend explains he used his student loan to open up a brokerage account, trading tech stocks during the boom years. To Navinder, this is shocking. Making money from a computer instead of working long hours at a shop or a supermarket seems almost unreal. That night, he starts reading everything he can about trading, online forums, books, market charts. He absorbs it obsessively. The same obsessive focus that once had him playing FIFA for hours, climbing into the top 200 players worldwide, now shifts entirely to trading. In FIFA, he studied how opponents played, memorizing their habits and counters. In markets, he begins applying the same logic, searching for repeated behaviors, waiting for openings. He opens his first small account using his own money. His early trades are clumsy. Losses pile up, but he treats them as tuition. By the time he finishes university, he is no longer just a curious student. He is convinced this is the only path he wants to pursue. April 30th, 2003. Navinder is back home in Hounslow after university, living in his old bedroom. He takes odd jobs to contribute to household expenses, telesales at a company called Dialaphone, then an admin role at Bank of America. But the work feels pointless. He still wants to trade. One evening, a newspaper ad catches his eye. Wanted, futures traders, must work well under pressure. The ad leads him to Independent Derivative Traders, or IDT, later Futex, a small London futures trading arcade. Applicants face a ruthless selection process. The first round is rapid-fire mental math and pattern recognition. Many are eliminated instantly. Navinder passes. Next comes hypothetical trade scenarios. Candidates are asked to react to sudden price moves, justify their reasoning, and defend it under pressure. By May 2003, only a handful survive. Among them is Navinder. Inside the office, he enters a world unlike any corporate bank. Rows of desks, each with screens flashing order books and charts. Market news blares constantly from loudspeakers. The Rossi brothers, Paolo and Marco, run the firm with trader Dan Goldberg. Paolo, the founder, drives a Ferrari, tells war stories from the pit trading days, and pushes new recruits to believe they're gambling for high stakes. Navinder is assigned to train on the S&P 500 E-mini futures. the world's most liquid contract. His method is simple: sit at the ladder, click in and out of trades, and repeat for hours. The environment is intense. Dozens of young men, all chasing quick profits, shouting across the room as they take positions. But Navinder withdraws into silence. Colleagues describe him as absent-minded, sometimes starting his trading day with his bike helmet still on. He rarely joins the group at the pub. He doesn't care for Paolo's charisma. He is there for one purpose: to master the ladder. Navinder develops his own style. He scalps, entering and exiting positions rapidly, sometimes dozens of times per session. Unlike most, he refuses to use stop losses. He calls it letting trades breathe. Riskier, but it fits his temperament. If a losing trade rebounds, he recovers the position. If it doesn't, he absorbs the loss and moves on. By focusing only on the E-mini, he starts recognizing patterns. Even in anonymous digital markets, traders leave fingerprints, recurring order sizes, sequences of plays. He studies them relentlessly, just as he once studied opponents in FIFA. But tension builds with management. Marco Rossi, who oversees risk allocation, limits the size each trader can control. Whenever Navinder posts strong returns, he storms into Marco's office demanding more capital and bigger limits. Arguments spill onto the trading floor, both men shouting in front of everyone. The only reason Navinder isn't fired is simple. He backs up his arrogance with results. Futex, as the firm rebrands in 2005, thrives and recruits more traders. For Navinder, it is the perfect environment to sharpen his edge, but underneath, his frustration grows. He feels constrained, certain that if he had more freedom, he could dominate the markets on his own terms. By 2007, Navinder's skills have matured. His account, once small and fragile, now holds several £100,000. Years of scalping the E-mini have hardened his instincts. Still, he feels restless. He wants more than survival. He wants to dominate. That year, he notices something unusual in the DAX, Germany's leading stock index. During late sessions, when most markets are falling, the DAX often creeps upward. Large buy orders appear on the ladder, only to vanish when hit, then reappear again. Navinder has never seen behavior like this. He turns to his colleague and friend at Futex, Young, who specializes in the DAX. Even Young is surprised. Together, they track the movement for days. The orders never seem to relent. Then, one morning, the pattern breaks. The DAX opens far lower. Whoever had been buying gave up overnight. Navinder and Young devise a simple strategy: short the DAX in the evening, hold overnight, and cover in the morning. It works. For 2 weeks, they repeat the trade, each time pocketing profits. But while Young keeps pressing intraday and gives back much of his gains, Navinder stays disciplined. He doubles down only when the setup is clear. His balance quickly grows. By January 2008, Navinder's account crosses £1 million. Just days later, news breaks. The mystery buyer had been Jérôme Kerviel, a 31-year-old Société Générale trader who secretly placed massive, unauthorized bets on the DAX. When the scandal is exposed, the bank loses $7.2 billion. Markets sink further. Navinder's short strategy pays off again. The timing could not have been more volatile. The global financial crisis is unfolding. Lehman Brothers collapses. Liquidity evaporates. The E-mini, once moving in steady ticks, now swings violently by several percent in a single day. For many traders, it's chaos. For Navinder, it's opportunity. On November 25, 2008, the U.S. Federal Reserve announces a massive rescue package, $600 billion in purchases of mortgage-backed securities. Markets spike. Most traders hesitate, fearing another collapse. Navinder does the opposite. He doubles down, buying aggressively. As the U.S. session closes, his broker calls in a panic. Navinder is near his margin limit and hasn't placed a stop. He brushes it off. "Look at the charts," he replies, and hangs up. The next day, the markets surge again. His position explodes in value. By the time he closes out, Navinder has made an estimated $15 million on this single trade. From that moment, he believes he is no longer just a scalper. He has beaten the system at its most chaotic moment. In his mind, he's ready for a bigger fight. not just against other traders, but against the machines now reshaping the markets. 2 years later, in 2009, the markets are changing. Navinder notices it every day on the ladder. Orders appear and vanish in microseconds. Fills are faster than any human can react. His edge, watching patterns, exploiting repeated behaviors, is slipping away. The opponents are no longer traders sitting at desks. They are algorithms. Firms like Getco, Jump Trading, and Citadel deploy automated systems capable of thousands of trades per second. Exchanges, eager for volume, reward them with discounted fees. The playing field is tilting, and Navinder feels pushed aside. Frustrated, he decides to fight back. Instead of trying to beat the algos at speed, he imagines disrupting their signals. If they react to the order book, what if he could manipulate what they see? In June 2009, he emails his broker with a detailed request for custom software. The subject line, Matrix. The specifications are precise. A cancel if close function, so orders disappear the instant another price approaches. The ability to layer orders at multiple prices with one click. Constant adjustment. If someone moves their order, his would move too, always staying one step ahead. The option to control position size, pulling orders automatically if the visible volume drops. This was not about speed, it was about control. He hires an engineer, Antonio Hedrigialis, to build the tool. After a series of meetings in London, Antonio delivers the first version. The cancel if close function works. The back of the book layering is harder, but progress is made. Navinder begins testing it. He places large orders away from the market, constantly moving them so they appear real but never execute. To outsiders, it looks like heavy supply or demand is waiting. In reality, the orders vanish before they can be filled. Regulators notice. In March 2009, the CME sends him a warning. Other traders are reporting suspicious activity. His orders keep disappearing. Navinder replies bluntly, "Sorry, I was just showing a friend of mine what high-frequency firms do almost 24 hours a day. Does this mean you're cracking down on them, too?" The next day, he switches the program back on. From then on, his trading routine changes. He spends long nights in his parents' house in Hounslow, alone in his bedroom, operating a tool few others even understand. He tells no one about the profits, not his friends, not his family. It is the birth of a new strategy, one that will push him into direct conflict with the global financial system. On May 6, 2010, Navinder sits at his desk in Hounslow. It is afternoon in London, morning in Chicago. The E-mini S&P 500 futures, the world's most traded equity contract, are unusually volatile. Navinder prepares his program. At 3:20 London time, 10:20 a.m. in Chicago, he activates the cancel if close function. On the screen, 6 massive sell orders appear, totaling more than $200 million in nominal value. They sit just above the best offer, constantly refreshing as the market moves. To anyone watching the order book, it looks like heavy selling pressure is waiting to strike. The orders are never meant to fill. Each time the price approaches, the program cancels them and replaces them a tick higher. In one 6-minute window, the system modifies or cancels 604 orders. Navinder barely touches the mouse. The tool does the work for him. For more than 2 hours, he keeps the program running. It feeds the illusion of overwhelming supply into an already fragile market. Other algorithms react, pulling liquidity. Depth thins. Every small order now has an exaggerated effect. At 2:41 p.m. New York time, the pressure snaps. The E-mini collapses. In just 4 minutes, the market drops 5%, the steepest fall in modern history. Trading halts. For 5 minutes, silence. Then, just as quickly, prices rebound. By the end of the session, trillions in value have been erased and recovered on paper. Around the world, investors are stunned. Navinder closes his day with profits of roughly $435,000. Some accounts put it closer to $879,000. To him, it's just another successful session. He shuts down the program and leaves his desk. The headlines the next morning don't mention him. They blame high-frequency trading, a glitch, or a large institutional sell order. Navinder's role remains hidden, but in the data, his fingerprints are clear. Regulators will spend the next 5 years dissecting every millisecond, tracing the collapse back to one bedroom in Hounslow. In the months after the flash crash, Navinder keeps trading. He doesn't slow down. If anything, he leans harder into his strategy. By 2011, he refines his program further. More functions are added. Automatic layering, one-click placement across multiple price levels, built-in position controls. But Navinder is not fighting only the market. He is fighting perception as well. Among other traders, he has a reputation. Online, he posts on forums under the name That's Fugazi, with the Joker avatar. He mocks traditional chart patterns, ridiculing techniques like Elliott waves or Gann theory. To him, they are useless. He insists the only truth is in the order book, and he alone has mastered it. At Futex, his attitude had already made him difficult. He challenged managers, cursed at colleagues, demanded higher limits. Now, on his own, there is no restraint. He trades only for himself, from his parents' home in Hounslow. His routine is relentless. Long nights staring at the ladder, occasional breaks for food or football manager on his phone, then back to the screen. The profits are extraordinary. Millions accumulate across his accounts, yet he tells no one. He lives like nothing has changed, cycling around the neighborhood, carrying the same old backpack. But his frustration with the system grows. He sees the rise of high-frequency trading firms, GetGo, Jump, Citadel, firms backed by billions, operating servers inches away from exchange data centers, securing fee discounts that human traders will never get. To him, the game is rigged. The rich have rewritten the rules. He begins speaking more openly about it. In conversations and online, he compares the markets to a rigged machine, run by elites and shielded by regulators. In his eyes, he isn't cheating, he's fighting back. For years, regulators review data, but they focus on institutional sellers and technical glitches. Navinder slips under the radar. Still, the complaints about disappearing orders continue, and his activities are flagged multiple times. He ignores the warnings. From the outside, he looks like a small independent trader. In reality, he is a one-man operation moving hundreds of millions in visible orders. His enemies are not other scalpers anymore. They are the world's largest trading firms and the regulators who quietly begin to close in. 2012, Navinder is a millionaire many times over. His trading tool works exactly as he wants, and his accounts show steady growth. But success brings a new problem: money management. He has millions in profits, but no clear plan to protect them. That is when a new figure enters his life, a man known to him as Mr. Jesus. His real name is Jesus Alejandro Garcia Alvarez, a Spanish money manager with connections to offshore firms. He approaches Navinder with a promise: safe investments, 30% annual returns, and ways to shield his money from taxes. To Navinder, who distrusts banks and regulators, it sounds perfect. He agrees. Over time, he channels tens of millions through offshore accounts managed by Jesus. On paper, the numbers look strong. Jesus sends regular updates, showing profits and growth. He even pitches opportunities in new gaming companies, telling Navinder he is part of something bigger. But the reality is different. Behind the scenes, Jesus is running a pyramid scheme. Old investors are paid off with new investor money. The accounts are smoke and mirrors. The investments don't exist. For Navinder, the trap isn't obvious. He's focused on trading. Day after day, he sits at the screens, clicking in and out of the ladder, assuming his fortune is compounding offshore. In truth, the wealth he believes he has built is already evaporating. By the time regulators finally close in on him, most of the money will be gone, drained into a fraud he never saw coming. Years later, November 2014, regulators have reconstructed the events of the flash crash. Millisecond by millisecond, they trace the order book. One name keeps appearing: Navinder Singh Sarao. His program has been layering thousands of contracts, refreshing and canceling at abnormal rates. For years, he has escaped notice, blending into the noise of global markets. But now, the picture is clear. A single retail-style trader in Hounslow had been moving visible orders worth hundreds of millions. On April 21, 2015, the knock comes. In a joint operation, US and UK authorities arrest Navinder at his parents' house. The headlines erupt: flash crash trader, Reporters swarm outside the modest home in Hounslow, filming the man accused of causing chaos in world markets. The timing is brutal. Navinder turns to his offshore accounts for bail money, only to discover the truth about Mr. Jesus. The fortune he believed was secure has vanished. The pyramid scheme collapses, leaving nothing to recover. The weight is crushing. Facing extradition to the United States, multi-million-dollar penalties, and the collapse of his life's work, Navinder's mental state deteriorates. In prison, his autism and isolation push him to breaking point. When his cellmate attempts suicide, Navinder holds him up for minutes, screaming for guards until help arrives. The moment scars him. Meanwhile, prosecutors push for the maximum. They paint him as the architect of market manipulation, a man who brought Wall Street to its knees. Traders online push back. Some rally under #FreeNav, calling him a scapegoat, pointing to academic studies that say his impact was marginal compared to massive institutional trades. Navinder is trapped between two realities. To regulators, he is a criminal who manipulated the system. To fellow traders, he is a legend, the scalper who fought the machines and paid the price. The legal battle stretches for years. In 2016, Navinder reaches a settlement with the U.S. Commodity Futures Trading Commission. The order is devastating. Over $38 million in penalties, restitution, and disgorgement. The criminal case drags on. Prosecutors press for prison. Defense lawyers present a different picture. A socially isolated man with autism, obsessively focused on numbers, who spent years clicking a mouse in his bedroom, not a Wall Street kingpin. In January 2020, the court delivered its judgment. Against all expectations, Navinder avoids prison. The judge cites his autism diagnosis, his cooperation with investigators, and the collapse of his finances. Instead, he receives time served, probation, and restrictions on future trading. By then, his reputation has already split in two. In the financial press, he is branded the flash crash trader, the man blamed for the sharpest collapse in modern markets. Among day traders, he is seen differently, a retail outsider who dared to fight against billion-dollar firms and their algorithms. Academic research later shows his effect on May 6, 2010 was real but limited. At most, his spoofing contributed to a fraction of the total drop. The larger forces were institutional sell programs and the collapse of market liquidity. Still, Navinder became the name history remembered. Before sentencing, he spoke briefly in court. His words were simple. "I spent 36 years trying to find happiness on a path built on a lie. I did things society said would give you happiness, and when they didn't, I didn't know where to look." May 6, 2010 remains etched in financial history, a day when markets fell off a cliff and rebounded in minutes, a day when trillions in value briefly vanished.